Say about these things. Please welcome to the show, Mr. Craig Bolanos. He's co-founder and wealth manager or wealth advisor at the VestGen Wealth Partners. Craig, we were on the phone together last Friday when non-farm payroll came out. And I think this is the market reaction. You were worried about happening Friday, but it just waited a few days. What do you think?
I think possibly, right? I mean, listen, I was thrilled that we printed 151,000 jobs on Friday and confirmed that unemployment rate of 4.1%. That's still a great number. I think the sell-off here is actually justified. I think it's meaningful. I think it's overdue. And when Trump announced just a little bit ago, within the last hour, in a retaliatory move that he wanted to double the tariffs to 50% on Canada, well, you know what? That should cause all the market indices to get to correction territory. But I think the bottom's coming, and it's close.
Yeah, and I mean, my social media was lit up yesterday and the day before, and what do you think about Trump? What's going on? This is crazy. I feel like the world's ending. But I said, before today opened up, if you just look at the big picture, we're back to where we were in September, like just before the election. And if you didn't feel like your hair was on fire then or the world was ending then, well, then it's not ending today. I know it's managing a lot of those emotions. And that's hard when you've got your retirement at stake, right? So you're looking after people's retirements. That must, you must be a kind of a counselor right now as well as a money manager.
That's correct. This entire move is about sentiment. This is a fear-based move. I mean, where's the data to support, Scott? I know in the Fox interview on Sunday, Donald Trump didn't rule out a recession, but it's also not probable. Anything's possible. Aliens invading Los Angeles is certainly possible. I've watched enough movies, but I have yet to see a recession start when you have job growth. You don't have widespread earnings cuts. When you have consumers that are still spending money, that's the current state of affairs. And too many people are looking to call a bottom here. The bottom in the correction is a bit of a process, but if you ask me, it feels an awful lot like a little bit of capitulation on a Tuesday. I think we'll get another day of this, and that might be about it. But that doesn't mean the market just goes straight to the sky. It means 2025 is going to be your year of churning, trading sideways, and then ultimately, I think, grinding higher.
Well, and we've got that 10-year yield around 4.25-ish, whatever it is today, 4.2, 4.25. It goes back to some of the things that we've seen on the show. We've said Deutsche Bank said that they believe this year we'll see a 10 to 15% rise in equity prices from the close of last year. Now, they're already offside on that one for sure, with a 4.75, 10% yield for the entirety of the year. I mean, those things, it's still so early, we could see those things happening. But you've got to admit, a lot of the high flyers, the Magnificent Seven, here's the interesting thing. They've taken it hard on the chin, right? They may be overextended, whatever you want to say. But none of them have anything to do with tariffs.
No, they don't. But this is underneath this market. This is still about rotation. Look at the difference between S&P 500 cap weighted and S&P 500 equal weighted. This is ultimately a rotation story, and it's also a geography story too. I'm sure the president's not thrilled to see those European stocks and those emerging market stocks all in positive territory while the U.S. is in red on a year-to-date basis. So I think this is nothing more than a pivotal pause, a professional pause that people can use to reassess their asset allocation, because too many people were long the Magnificent Seven, the Elite Eight, whatever acronym you want to use. And I don't know that that's the next story of the U.S. growth engine.
Right. And so I want the viewers to understand that, we've got this measure of money called the M2. It's money supply, money in the system, right? And the last administration flooded the system with so much money, up to, say, 10 trillion, depending on who's counting. And what that does is that you're going to have some growth. You're going to be buying some GDP, right? It's going to be hard to have a recession if you've got that much money sloshing around. But when you take money out of the system, which is what Doge is doing, what the president wants to just do naturally, that's when the tide goes out and you see all the bikes that people stole and then they throw them in the water, right? And I think that ultimately folks need to know that when you shrink the money in the system, that shrinks the economy, and there is going to be a short term. So I think, we'll be slowing before they're growing, right? That's what people need to get ready for, and I think he needs to get out in front of that. What do you think about that?
Scott, for the first time since I've met you, you're showing your age. No one steals bikes anymore. There's no more bikes. There's scooters.
All right,
People are stealing the scooters and tossing them in the water when the tide goes out. So I think there's some truth to what you're suggesting to everybody that, the gig is up. Trees don't grow out of the sky, and valuations ultimately need to make sense because this is a math problem. But if people want to stay data driven and they want to stay data dependent, I think everyone should be making decisions, not what's on possible. You should make decisions on what's probable. Because if you follow the probability in 23 and 24, I got news. You made money.
Right.
And the data has not yet soured. A lot of this is, again, fear of what to come. But love your analogy, but change the bicycle to a scooter to reflect the current state of affairs.
All righty, brother. Thanks for coming on. Great stuff as usual. Craig Bolanos coming to us from Chicago. He's with he's a co-founder and manager of VestGen